Can Taxes and Bonds Finance Government Spending? By Stephanie Bell. Section 2. The Reserve Effects of Taxing and Spending. Before examining the reserve effects of various Treasury operations, it is, perhaps, prudent to begin by looking closely at aggregate member bank reserves. Footnote 2. Although reserve requirements are generally met by holding a combination of vault cash and checking accounts at district Federal Reserve banks, accounts held by depository institutions at Federal Home Loan Banks, the National Credit Union Administration's Central Liquidity Facility, or correspondent banks may also count toward satisfying the reserve requirement. Depository institutions do not have to meet these reserve requirements on a daily basis. They have a 2-week reserve period ending on Wednesdays, within which they must maintain average daily total reserves equal to the required percentage of average daily transactions accounts held during the 2-week period be ending the preceding Monday. Thus, despite being referred to as a contemporaneous reserve accounting (CRA) system, it is, in practice, lagged for 2 days. That is, banks always have 2 days, Tuesday and Wednesday, within which to acquire ex post reserves needed to eliminate a known deficiency. While some banks may choose to hold excess reserves, profit-maximizing banks will economize on reserves. Unless a bank has a preference for idle funds, it will exchange excess reserves for earning assets, such as loans or securities. Beginning with the Federal Reserve's balance sheet, equivalent terms can be added to each side, and the entries can be manipulated algebraically in order to isolate member bank reserves. The result, often referred to as the reserve equation, depicts total member bank reserves as the difference between alternative sources and uses of reserve funds. The reserve equation can be written as total member bank reserves equals the sum of sources, Federal Reserve credit, U.S. government securities loans to member banks float, plus gold, plus SDR certificates, plus Treasury, minus the sum of uses, currency in circulation, plus U.S. Treasury balance at Fed, plus foreign balances at Fed, plus Treasury cash, plus other Fed deposits and accounts, net. From Figure 1, it is clear that an increase in any of the bracketed terms on the left will increase reserves, while an increase in any of the bracketed terms on the right will reduce them. Section 2.1. Reserve Effects of Taxing and Spending. In this section, the reserve effects of 2 important Treasury operations, government spending and taxing, will be analyzed. To emphasize the impact of these operations on bank reserves, the case in which all government payments and receipts are immediately debited to accounts held at reserve banks will be considered. Footnote 4. It is, of course, true that the Treasury keeps accounts at thousands of commercial banks and other depository institutions as well as Federal Reserve banks. This changes things considerably and will be taken up in the next section. When the government spends, it writes a check on its account at the Federal Reserve. Assuming the check is deposited into an account at a commercial bank, member bank reserves rise by the amount of the check as the Federal Reserve debits the Treasury's account, decreasing the right-hand bracket RHB in Figure 1, and credits the account of a commercial bank. Thus, a system-wide increase in member bank reserves results whenever a check drawn on a Treasury account at a Federal Reserve bank is deposited with a commercial bank. Government spending, then, increases aggregate bank reserves ceteris paribus. When instead of drawing on its account at the Fed, the Treasury receives funds into this account, the reverse is true. For example, if a taxpayer pays his taxes by sending a check to the IRS, his bank and the banking system as a whole lose an equivalent amount of reserves as the IRS deposits the check into the Treasury's account at the Federal Reserve. Total member bank reserves decline as the RHB in Figure 1 increases. Thus, the payment of taxes by check results in a system-wide decrease in member bank reserves. Ceteris paribus. Footnote 5. It is worth noting that government spending must originally have preceded taxation. That is, the payment of taxes could not increase the Treasury's account at the Fed, RHB term, reducing bank reserves until the reserves had been created. Moreover, the Federal Reserve and/or Treasury, as the only agents capable of supplying them, must have been the original source of these reserves. This will be taken up in Section 5. If Treasury spending out of its accounts at Federal Reserve banks were perfectly coordinated with tax receipts deposited directly into the Treasury's accounts at Reserve banks, their opposing effects on reserves would offset one another. That is, if the government ran a balanced budget with daily tax receipts and government spending timed to offset one another, there would be no net effect on bank reserves. However, as Figure 2 shows, the Treasury's daily receipts and disbursements from accounts at reserve banks are highly incommensurate. Indeed, they differ by almost $6 billion. Thus, despite an attenuation of the reserve effect due to the simultaneous injection and withdrawal of reserves, government spending and taxation will never perfectly offset one another. Even if a more even pattern could be established, some discrepancies would persist because, as Irvin Auerbach recognized, there is no way to determine in advance with complete accuracy the total amount of the receipts or the speed at which the revenue collectors will be able to process the returns. Thus, while concurrent government spending and taxation have some offsetting impacts on reserves, the reserve effect from the Treasury's daily cash operations would still be substantially, especially if they were channeled immediately through the Treasurer's balance at the reserves banks. Section 2.2. The importance of the reserve effect. The inability to perfectly coordinate Treasury receipts and expenditures has serious implications for the level of bank reserves and, subsequently, the money market. Because banks are required by law to hold reserves against some fraction of their deposits, but earn no interest on reserves held in excess of this amount, they will normally prefer not to hold substantial excess reserves. Government spending, then, will leave them with more reserves than they need to hold, while the clearing of tax payments will leave them with fewer reserves than are required. Ceteris paribus. The Fed funds market is the market of first resort for banks wishing to rid themselves of excess reserves or to acquire reserves needed to meet deficiencies. When there is a buildup of reserves within the system, many banks will attempt to lend reserves in the federal funds market. The problem, of course, is that lending reserves in the funds market cannot help a banking system which began with an equilibrium level of reserves to rid itself of excess reserves. Moreover, when the system is flush with excess reserves, banks will find that there are no bidders for these funds, and the federal funds rate may fall to a 0% bid. Likewise, the clearing of tax payments will leave a banking system which began with an equilibrium level of reserves short of required and/or desired reserves. Banks will look to the funds market to acquire needed reserves, but since all banks cannot return to an equilibrium reserve position by borrowing federal funds, a system-wide shortage will persist. That is, like a system-wide surplus, a system-wide deficiency cannot be alleviated through the funds market. Attempts to do so will simply drive the funds rate higher and higher. Footnote 6. When there is a reserve deficiency for the banking system as a whole, banks could attempt to resolve the deficiency by reducing deposits. If a single bank begins this process, selling U.S. securities to a member of the non-bank public or allowing loans to be repaid without reissuing them, it will result in a multiple contraction of deposits, assuming all banks follow suit. Though this would ultimately eliminate the banking system's reserve deficiency without requiring banks to acquire additional reserves, the process takes time and will disrupt interest rates until equilibrium is restored. Deficiencies will, therefore, usually be eliminated as the banking system acquires more reserves, not as it reduces deposits that reserves are required to back up. Importantly, the funds rate is not the only interest rate affected by changes in the level of bank reserves. As the focus of monetary policy, the funds rate is the anchor for all other interest rates. Thus, when banks are content with their reserve positions, Treasury operations such as government spending and taxation disrupt these positions by adding or draining reserves, and banks react to these changes by first turning to the funds market. There, the funds rate is bid up or down, and other short-term interest rates are affected. Although some individual banks will be successful in eliminating their own reserve deficiencies excesses, the banking system as a whole will not be able to alleviate a shortage deficiency on its own. Only through government adding, draining of reserves can a system-wide imbalance be eliminated. Because attempts to resolve system-wide reserve disequilibrium through the funds market can affect a number of other interest rates, a variety of procedures have been developed to mitigate the adverse impact of Treasury operations on banks' reserve positions.